Hello, my name is Doug Murphy. I'm Vice President of National Accounts with Baltimore Life Insurance Company. I want to talk to you today about asset transfer for the middle market. Key here is that I'm putting emphasis on the terms middle market. These products aren't designed for high net worth individuals. We're looking at the average premium being somewhere around $60,000 to $62,000 for us as a company. That's typically what you find in typical annuity clients that hold annuities or other types of assets. It's a relatively small amount, but it is really designed for the asset transfer for clients in the middle market. It is simplified issue products, so there's not going to be a huge amount of underwriting on this. There's no underwriting that goes into this that requires any types of parameds, blood work, or anything like that. The last thing I want to emphasize on this screen is we want to help you grow your business. We're not here just to take business from other companies. We're here to help you actually grow your business and to give you more arrows in your quiver that you can use to talk to your clients about needs that they may have and to address those needs. When we talk about asset transfer for the middle market, the first place I want to start is what's important to your clients. What's important to your clients we see is living comfortably in retirement. That doesn't mean they want to be well off. That doesn't mean they want to have all kinds of money. They just want to live comfortably. They want to maintain good health. They want happiness and welfare for their children and grandchildren, and they want to leave assets to their heirs. But they need guidance from an agent like yourself. They want an agent that understands the client's needs, that helps them arrive at a solution. And then the last dot point there, I always put some emphasis on the client should understand that solution within 5 minutes. Now, there's nothing magical about that 5 minutes. I just kind of put that there as to try to express the idea that, we want these to be, they're simple products, or simple terminology, simple concepts. And I think as we go through this presentation, that you see that they're fairly easy for a client to understand, especially those clients that say, hey, I have funds set aside that I don't plan to live off of, that I want to pass on to my heirs or my church or charity or something like that. Now, when you talk to senior clients, and all of these are going to be senior clients that you're talking to about these products, typically these clients will break down their retirement planning process into 3 different buckets. Now, sometimes they'll do this on paper. Sometimes they'll do this with an advisor, a financial planner. Sometimes they're doing it with you. Sometimes they just do it in their own mind and they don't have anything written down. But really how they break it down is they break it down into 3 buckets. In this case, I've used this as kind of a mason jar type of aspect. But first bucket is going to be retirement funds. The second one is going to be contingency funds, or what I call that what if money. What if I need money for a new car repair, or a new roof on my house, or I have some type of medical expenses. I don't want my kids being responsible for any type of care expenses and things like that. I need money that I want to have available for that kind of thing. And then any money that's left over, they want to leave as much of their funds and their assets as they can to their heirs, and that's the legacy fund. Now, I realize that most of this can be done through trusts, but most middle market clients don't want to undergo the effort, and they also don't want to give up any control of those assets. When you think about retirement funds, I've included here as retirement funds expected Social Security benefit, pension plans, and in this case, it's defined benefit pension plans. And for those of you that are younger agents, you may not even know what a defined benefit pension plan is. But prior to the 2000s, probably the mid 90s at the latest, a lot of companies out there had a defined benefit pension plan where they were responsible for contributing to the pension of the employee solely. They would invest that money, and then they would provide a certain amount of pension benefit when a client reached a certain age, certain amount of service, and their retirement age. Those kind of went away because of the expense of those to the employer. And once those went away, 401ks, 403bs, that kind of thing become extremely popular and became something that companies would rather contribute to those kind of things and matching funds than they would be for being responsible for the total funding and also the investments of something to make sure that a client's retirement program met a certain level. So what you've seen since the mid to late 90s is a move towards 401ks, but there are a lot of senior clients out there that have defined benefit pension plans, and I'll come back to that in a minute. According to a 2017 American College study of people between the ages of 65 and 70, 75% of this group had a defined benefit pension plan. Keep that in mind in just a moment, because I think it's going to highlight some things for you. But again, people between the ages of 65 and 70, 75% of them had that defined benefit pension plan that I mentioned there. So when you go to baby boomers entering retirement, these are retiring baby boomers that haven't necessarily retired yet, but are on the verge of it. Retiring baby boomers have a medium savings of $147,000 in all household retirement accounts. Now that doesn't sound like a lot, but that's actually up from $99,000 in 2012. 22% of baby boom workers, people still working, but in that baby boom category, have less than $55,000 saved. But if that sounds almost hard to believe. But when you think about that, only 51%, a little over half of this 22%, are very concerned about outliving their savings in retirement. So even though they've got less than $55,000 saved, half of that group feel like they're not concerned about outliving their savings in retirement. So why could that be? I mean, you think about that. That doesn't seem like a lot. And you're thinking, why are we talking about asset transfer when there doesn't seem like there's a lot of assets set aside there to transfer? But when you think back to that previous screen, it's 75% of these seniors had defined benefit pension plans. I would challenge you to think that a lot of these seniors are living off of their Social Security and their defined benefit pension plans. Those that had 401k set up towards the end of their work years, or maybe still in their work years and still have their 401k plan to use that, just kind of leave that money out there for that what if money. What if I need it to help contribute towards my retirement? What if I need it for a major medical expense or a long-term care type of expense? What if I need it for a new roof or a new car repair or something like that? They want that money available, and that's what they've got that 401k money setting aside out there for. And they truly are living off of their Social Security benefit and any defined benefit pension plan that they would have received prior to that. I know a lot of seniors that fall into that. You probably have a lot of seniors when you have this conversation with them that will express that to you as well. So we move to contingency funds. These are assets that your client don't expect to use to retire off of. Now, it's hard to know that, but when you're talking to them, a lot of them have a good idea of how they've got money set aside and planned for. They are worried about those contingencies. I'll show you how our products can help address those things a little later with using the loan value and the accelerated death benefit features and things like that. But the client is worried about contingency funds. You can't overlook it in the sales process. You want to make sure these products are designed. If a client says, "Hey, I may need those to live off of later in my life," this is probably not the best place to put their funds is in these products, because they are life insurance products. They're designed to pay a death benefit, and that's the primary feature of it. Again, they do have some cash value benefits, some loan value, and then some accelerated death benefit features as well too. But you want to set these funds set aside to handle expected financial crisis or a medical need. Maybe they're worried about an underperforming retirement fund, or maybe they're even worried about outliving their retirement funds. Now, I realize life insurance may be an opportunity for your client to increase the value of this fund, but we're really talking about the cash value of that as well too. So as you think about that, we've addressed how the client views their retirement bucket, their contingency funds, and we can't overlook that. Client is always going to have that as a concern. So we've got, and somehow in the products that we're going to talk to you about, we've somehow got to address those contingency funds and how a client can help meet those needs if they put money into these types of products. We have two products that's designed to meet the legacy aspect of that, passing on as much money as you can to your heirs, or church or charity, whatever the beneficiaries that the client wants on that, or where they want their funds to go to. And the first product is a single premium whole life. The other product is a generation legacy. Now, what I'm showing you here on this screen is a flyer that you can get, that's available to you. It's available on our Secure Agent website. You can go out and download this flyer. And I think it's a good flyer that shows you a comparison of the two products. You'll see a bunch of differences there all the way down through there. And for every one of those differences, there's a reason for it. Sometimes it's in the structure of the policy. Sometimes it's because of the mortality, how the mortality plays into it. But most of the time it's in the structure of it. So let's start with, how would you identify which product you should sell to a client that may have funds that they don't feel like they need for retirement purposes, or to live off of as they go through retirement? I would tell you that the best place to look is, what's the source of the premium? What's the premium source? If it's after-tax money, CD money, money market money, 1035 exchange money, that money is best probably to go into our single premium whole life. It's cash money. Money's already been taxed. You're going to make a one-time premium payment. It's going to buy a lump sum death benefit. They're never going to make another premium payment. And the cash value, what are the cash values set at after the premiums paid? That cash value will then continue to go up and not go down. It is a whole life chassis product, not a universal life in any aspect. So it is a great vehicle for that, for after-tax cash types of money. The Generation Legacy, on the other hand, is designed to get money out of annuities, qualified funds, non-qualified annuities, 401ks, 403bs, and move that money tax efficiently as we possibly can into life insurance. Now, as an agent, you realize that you can't 1035 exchange life annuities into life insurance. You can 1035 exchange life insurance cash value into an annuity, but you cannot 1035 exchange an annuity into life insurance. So the way we structure this Generation Legacy policy is that when you take the application, and also when you deliver the policy, you'll deliver two policies. You'll take on the application, you'll take an annuity app for single premium immediate annuity, and you'll also take a life insurance application for either a 10-pay or a 7-pay life policy. It'll be a 7-pay life policy if the client is between the ages of 74 and 80. If the client is between the ages of 60 and 74, it'll be a 10-pay policy. Now, there's differences in the underwriting class. I'll tell you that the single premium whole life has 2 levels. Standard to table 4 is level 1. Level 2 is tables 5 through 8. And really the only difference there, let's say you have a client with a $50,000 premium payment or cash available, and they're going to use that to buy life insurance. Let's say they're in relatively good health. They qualify for level 1 at standard to table 4. That might buy, based off of their age, it might buy $78,000 of death benefit. However, the same client may have some health impairments, maybe some comorbidities. That same $50,000 in premium may only buy them $74,000, $75,000 of death benefit. So it's the same premium. We're just going to reduce the death benefit based off of their health impairments. Now, there is no level 2 on the Generation Legacy, so keep that in mind. And this is also a good time to tell you that I'm not going to get into the weeds on all the product detail in this presentation, but it's also a good time. If you haven't went out to the Secure Agent website, you have to first be contracted in order to do that. Once you're contracted, you'll get an agent number and be able to go out and get information on how to set up the Secure Agent website. It is your own personal website with Baltimore Life. You have access to all your pending business there, all your contacts, any forms that you need. Just about anything that you have is available on that Secure Agent website. But it'll also have access to the agent guide and the underwriting guides. It's going to give you a lot more information than I can give you here in this very short presentation. One of the things we like to highlight is our point of sale underwriting. We have over a 90% point of sale underwriting decision right while you're there with the client. We don't want you leaving that client without knowing before you leave there whether or not that client's going to be approved medically for policy with Baltimore Life. If for some reason we decline them, but based off medical reasons, you're still there to write them an annuity or maybe another carrier that may take those impairments that we would not. The minimum premium for both products is $5,000. We won't go less than $5,000 for a premium. And I'm going to just lump the next 3 buckets there into that, what I call that contingency fund that we talked about earlier. Partial withdrawal options. Both products have partial withdrawal options from the cash value of the products. They have loan availability available for both products. And they also both offer accelerated death benefit. There's a few differences there in the partial withdrawals, especially in the accelerated death benefit, and there are differences. I would tell you that even though you look and say that it looks like there's a much more attractive accelerated death benefit feature under the single premium whole life than there is under the Generation Legacy, really the way the product is structured, those benefits work out about the same. In some cases, one may be better than the other, but based off of this and the way that the contracts are set up, one is not necessarily any better than the other when it's all said and done. The maximum face amounts that we have there, this is a maximum net amount. We use a maximum net amount at risk, which is the premium, the amount of premium paid versus the death benefit. So if the death benefit is $500,000 and the premium that you paid was $300,000, the net amount at risk would be $200,000. To kind of give you an idea how we're looking at that on the single premium whole life. You'll see there we'll only go up to $250,000 in net amount at risk for somebody between the ages of 50 and 80 for level 1. will, between the client between the ages of 81 and 85, will only go up to $150,000 of net amount at risk. And then level 2, you can see there too. Again, I don't want to get too far in the weeds on that, but the agent guide will outline that very closely and very specifically for you. The generation legacy, on the other hand, because I told you that we have a dual concept, it's going to be a single premium, immediate premium. Whatever that purchase is, will not go more than $450,000 of whole life policy. So we're going to issue up to $450,000 face amount on the whole life, whether it be a 7-pay whole life or a 10-pay whole life. And then we'll be able to tell you what that SPIA payment, or what that SPIA needs to be in order to generate whatever the face amount of that life policy is. But whatever that is, we won't go over $450,000 of death benefit there. If for some reason you have a client that you think exceeds these and you want to call us to get to see if we'll accept more premium on it, sometimes we'll be able to take more premium in those cases and raise the death benefit on those. If you've got cases like that individually, you want to call into our agent services number, and they'll be able to get you illustrations on those and let you know whether or not we can write those. And I'll provide you with that phone number at the end of the presentation. But again, if you've got amounts that exceed that, you can call our agent services line and talk with them about getting the proper illustration and whether or not we'd be able to take that kind of premium and that kind of mortality risk. And then the death benefit on the face amount of the single premium whole life is exactly what I said it is. You make a one-time premium payment, it buys a death benefit, and that death benefit will be whatever that single premium whole life is illustrated and shows on the policy as. Whereas the face amount on the whole life policy would be what is going to be the face amount of the whole life policy. Whatever the whole life policy is going to be a tax-free death benefit. And then if there's any money remaining in the SPIA, that money would also be either paid to the beneficiary in a commuted lump sum or continue to be paid out over the remaining period of time that annuity is in force. So let me show you an example of that. We're done now talking about the single premium whole life, because it's a fairly straightforward concept. Now, the generation legacy is a kind of a novel product in the marketplace, and let me give you an illustration that really highlights where the generation legacy comes in. And this is a typical client for us. This is a female, age 70, non-tobacco. She's got a $50,000 non-qualified annuity out there with a cost basis of $40,000. Now, for those of you who don't sell annuities, the cost basis of what she may have paid into it sometime in the past in cash and already paid tax on. So she paid tax of $40,000 on this sometime in the past. It's now worth $50,000, so we have a gain there of $10,000. Now, she could say, well, you're talking to this client, and this is probably a typical client for you as well, too. She could say that, I don't need this money to live off of. I've kind of got it out there for what if money. What if I need it for something, that contingency bucket? But if and when I die, I want this money just to be passed on to my 2 grandkids or my son or daughter. So in this case, this may be a great opportunity to talk to them about a generation legacy, in addition to maybe an annuity as well, too, to give them an option. But here, what we're going to look at doing is saying, okay, we're going to be able to take this lady's $50,000 annuity. We're going to 1035 exchange it from their current annuity, into our SPIA. So I mentioned earlier that you can 1035 annuity to annuity, but you can't 1035 annuity to a life insurance policy. So we're going to 1035 her annuity into our SPIA. So you see there in year 1, that single premium, it says $50,000. We've done that tax-free. We've moved it from her annuity into our annuity tax-free. So at that point, there's no tax paid on it at that point in time. At the same time we set that SPIA, that single premium immediate annuity, up for, we're also going to issue in this case, it's going to be a 10-pay life policy, because the client is 70 years of age, so it'll be a 10-pay life policy. We're going to issue that 10-pay life policy, which has a death benefit on it. You see to the very far right-hand side out there of $83,347 in this example. So we took her $50,000. She now has a tax-free death benefit that she'll pass on to her heirs of $83,347. So how are we going to pay for that whole life policy, that 10-pay life policy? Every year, once a year, we're going to take 10%. We're going to liquidate that SPIA over a 10-year period. So we're going to take that SPIA. We're going to take 10% of it, which is of the principal, plus the interest that we're applying to it. So in this example, it's $5,200 and $5,200 every year for 10 years. We're going to take out of that SPIA, and we're going to make an annual payment to the life insurance policy on this individual that's going to pay that annual premium payment on that $83,347 policy. Now, what's the benefit there to the client? So if that client said, okay, how am I benefiting from that? So what we're going to do is, out of that $5,250, we're going to exclude, in this example, $4,000, just over $4,000 of premium would be excluded from tax. She'd get a 1099 every year for the next 10 years of right at $1,249.50. It's a little more in year 10 just to equal it out, but right at $1,250 a year for those 10 years. So she'd pay tax on that. Now, typically for a client, based off of their other income, she may not pay any tax on that at all if you don't have much, if not any other income. However, if she's got other income, this typically won't put them into a higher tax bracket, but she will be required to file that $1,250 or so as part of her income tax every year. She'll get a 1099 from Baltimore Life on that. So she's spreading that tax liability on that $10,000 up there, and plus the interest that we pay her over a 10-year period. So it makes it negligible how much tax she's paying on that, and she can utilize the full $50,000 to buy as much insurance as possible. So she's maximized the amount of insurance. She's minimized the amount of tax that she's going to pay by spreading that out over a period of time. Plus, if you see that category there, SPIA benefit payable at death. Let's say this client dies in year 3. Her beneficiary would receive the $83,347 tax-free. Plus, they could choose as the beneficiary to continue to get the $5,250, the SPIA payout, because there's no longer life insurance once we pay the death claim, but that SPIA is still in force. That SPIA continued to be paid to them every year at $5,250 to the SPIA's paid out based off the remaining years. Or in that example, in year 3, they could commute that lump sum and say, I'm going to take a $30,200 lump sum payment, commuted lump sum payment, and then they would be required to pay, as a beneficiary on the rest of that SPIA, they would be required to pay the income tax on that at that point in time. So that SPIA payout, if what's remaining in that, would be taxable to the beneficiary, although that $83,347 is obviously tax-free because it is a tax-free death benefit on a life insurance policy. So you can see there what we're doing is liquidating that SPIA over a 10-year period of time. You see those $5,250 premium payments every year for 10 years. You see that SPIA benefit payable at death decreasing down every year because we're reducing the amount of that SPIA. But what we wanted to do there is we wanted to make sure that we're maximizing the death benefit, allowing them to keep that money separate into an annuity, because if that client died in year 3, there would have been no value in us taking all that money up front and charging that full $50,000 and then only paying an $83,000 death benefit and us keeping that remaining SPIA. Some companies that have a concept very similar to this do that. They consider it a temporary annuity. We pay both in the event of the client dies in that SPIA, in that annuity payout period. Now, at the end of 10 years, the SPIA has been liquidated. The whole life policy has been fully funded. It's a fully paid up whole life policy for $83,347 in this example. And the client is been able to move tax efficiently as possible her annuity into life insurance. So I hope that concept works for you. I would say take this same lady. She's 70 years old, again, non-tobacco. Let's say instead of having a $50,000 non-qualified annuity, she has a $50,000 IRA. So we would do the same thing, that we take 1035 exchange that over to our SPIA. That SPIA payout would still be $5,250. It would still buy an $83,347 death benefit to the far right-hand side. The SPIA payout benefit payable at death would still be the same. The only categories that would change, obviously, if it's an IRA, she's not paid tax on any of that before, so she's going to have to pay tax on all of it now. So instead, there would be no excluded amount for any of those years. So she'd get a 1099 for each of those years for $5,250. Now, how does that benefit the client? Would she rather pay tax on $50,000 IRA up front and then use what's left to buy life insurance? Or would she rather try to split those payments up over a 10-year period of time, plus get interest off of that balance and then split that up and pay tax on that each year. Now, $5,250, she's going to pay income tax on that. It could potentially throw her into a higher income tax bracket based off of her other income, but it's still minimizing the amount of tax that she's paying on that and her being able to maximize the amount of death benefit that she's passing on tax-free to her heirs. So I hope that's clear to you. You can kind of play around with that. You can use those illustrations. It's an illustration very similar to one that you can go out and run on a client once you have access to our Secure Agent website and have the software out there to do that. And I encourage you to do that. One of the things that we've come up with in the last few years, that recommendation of one of our marketing organizations and agents, was what we call a spouse option. And this is ideal for married couples if the spouse who owns the funding source, the annuity in most cases, can't qualify for life insurance. So you have, let's say that 70-year-old lady we just talked about had that $50,000 annuity, but she was uninsurable. Now, she may be married. Her spouse may be in better health than she is. So she has that annuity. She wants to pass it on to her heirs. Typically, spouses file taxes together. That's what we're going to make the assumption of. Right now, it can only be for in a spouse situation. It can't be for business partners or anyone else, children of the insured or anything else. So it has to be a spouse. So the spouse, what we would do is take the application on the annuity, on the Generation Legacy application. We would make the annuitant that has the annuity, we would make them the annuitant on the SPIA in their name. And then when the life portion of the life application is filled out, we would make the insurable spouse the applicant of the life policy. So what we're doing there is they're wanting, as a couple, they're wanting to pass on as much money as they can to their heirs, and we're doing that. They still file taxes together, but we've taken the funding source, the annuity, from one of them that's uninsurable, and being able to fund the life insurance policy on the insured client. So think of all the clients that you may have deal with out there currently, or may have passed up in the past for life insurance that you could not write life insurance for because you felt like that their health didn't qualify them for that. Think of all those people. Make a list of that. Get with your marketing organization, your upline, and they can help you get the information that you need to make sure you're properly prepared to go out and talk to these clients. The SPIA payout there continue to fund the life policy if the annuitant dies during the SPIA payout period. And then the annuitant waives the right for the beneficiary to commute any future SPIA payouts in a lump sum upon that annuitant's death. There's no maximum age limit for the annuitant when the annuitant is different than the insured. Now, a point of sale underwriting decision, again, we want to make sure that you're going to be able to get the underwriting decision before you leave that client's house. That's one of the things that, we don't want to cost you money because you're showing a Baltimore Life product for the client because you think it's the best product for to solve their situation and to meet their needs. Once you have the client complete the entire application, right now it is a paper application, and we're working on coming up with an e-app type of version of that as well too. But once you've completed the entire application and pre-qualified the applicant, you can call the call center. Usually lasts 12 minutes or less, and that professional call center representative will ask you to verify the contract state, the client's name, address, and state of birth, height and weight, and the last 4 digits of their Social Security number. And we do that even though we'll eventually get the full 4 digits of their Social Security number. We don't make you give that over the phone because some clients are apprehensive about that. And then we'll also get their gender. During that call, there'll be an MIB search and a prescription drug database search that'll be run in the background. Well, that takes just seconds, literally seconds, for that to come back while the call is going on. But we'll need a client. If you're doing it DocuSign, we'll need your client signature in order to do those background checks, the MIB, a prescription drug database check, and those kind of things. So we can either get a voice signature for that, or we can get a DocuSign if you're not doing it via voice. So we think it's a fairly smooth process for you from a point of sale process. Once the CCR will provide you with one of the following responses at the end of that. They'll come back and tell you the client is conditionally approved based on final review for Tier 1. For both the Generation Legacy and the SPWL. They'll say she or he's conditionally approved based on final review for Tier 2, and that would be for the single premium whole life only, since it is the only product that offers the Tier 2. Or they would tell you based off of the client's medical conditions, we we're going to decline the client. And that way, if we get a decline, it's better for you to know that there while you're still there with the client. The client still has in a buying frame of mind, or they're still looking at products that meet their needs. Maybe you have another company that would take that impairment, or maybe you have an annuity that you can go in there that would also somehow meet that client's specific needs as well too. I would tell you that fewer than 10% of the cases will be referred to the home office for any additional underwriting review, and that's usually where you have comorbidities. Where you're taking a drug that could be for different types of things and those kind of things. And we want to review those. And then it takes a very short amount of time for us to be able to review those and get you an underwriting decision back out. Call center that you're going to make the call into, that number. And again, this is available in your agent guide, your underwriting guide. You can make a note of it here. It's 855-467-769. Call center hours are 10 a.m. to 9 p.m. Monday through Thursday, and 9 a.m. to 6 p.m. Friday. And these are Eastern times. Language support include English and Spanish. Other languages are available on request. And I would tell you, if you got Spanish, if it's something that you have a Spanish, you might want to make a call to make sure that we have a Spanish translator available at that time when you're going to call in or primarily be with that client. We have a TTY also available for in English and Spanish if that's something that you're looking for. And then an interview must be completed in order to process the application. We can't process the application without that interview being done. And that interview must be completed within 5 days of the application. So if you took an application, you didn't have time to do the phone call or the underwriting part of that, you could come back and do that, but it's got to be within 5 days of the date on the application. Again, I want to point out we have a 90% pointed to sale decision rate or higher. We like to make sure that we're not wanting to cost you money. We want to make sure that you leave that house knowing that client's going to qualify or not. Now, sometimes I'm asked, where do you find these clients? What's a typical client? That's a question I'm always asked. What's a typical client or a really good client for these types of products? And I would tell you that as I think about it, they've raised the age now for when a client started to take required minimum distributions. And I would tell you that if a client now, age 73, they're being required to take required minimum distributions from their retirement funds out there, and you know that tells you the client probably retired somewhere around age 65 or thereabouts, and they're now 73 years of age or older, and they're having to take required minimum distribution. That tells you that they retired. They've now lived 8 years off not using these funds. The government's now requiring them to take these funds out. They don't know what to do with it. That tells you that they're probably never going to use those funds to live off of, but that they just got them kind of sitting there again for that what if money, that contingency fund bucket, for those types of things. So that's a really good client to start with. Always ask the questions. You're looking for annuities not needed for daily living expenses. Always be on the lookout for that, whether you work with annuities or not. Ask your clients if they have annuities, and if they do, what are they used for? I always like to have a conversation that's not kind of closed in. If I just ask you a specific question and you answer me yes or no, then it's kind of, there's nowhere for that conversation to go. But if I were to ask, Mr. Client, do you have any leave behind money? That client probably doesn't know what I'm talking about. So he's going to say, well, what do you mean by leave behind money? And that gives me an opportunity to have a conversation and say, well, if you have any money at all set aside for anything, it's either leave behind money you want to leave onto your heirs, or it's live on money that you intend to need to live off of. If it's live on money, there's annuities that you have available. That money's, it's a good place for those funds. It's not a good place for our life insurance policy. But if it's leave behind money and they've got money that they intend to leave behind, now's a good time to either talk about our single premium whole life or our generation legacy. A third option there is a 1035 exchange of older paid up policies. A lot of these seniors have 10 or more paid up policies. They were bought when they were kids. Sometimes they're $250 face amount policies, $500 face amount policies, $1,000 face amount policies. Along the stages of their life, their parents may have bought policies on them. Typically, they're 20 pay lives or shorter pay lives, so they're all paid up. They may have a small face amount. And they may have a death benefit or a cash value that's pretty close to whatever the death benefit is since they've had them so long. Look at that and say, okay, there's an opportunity there. Take those paid up policies, 1035 exchange those paid up policies, into a current mortality type product, one of these products, a single premium whole life, and in this example would probably work best. The 1035 exchange those into our single premium whole life. If the cash value buys a higher death benefit than the other, than all those products that they had combined, and a lot of those old products were under older commissioned mortality tables, and they may have not a very good face amount to death benefit, and the cash value is quite high. So you may be able to take a $17,000 or $18,000 cash value that they have $20,000 of total death benefit on now, and take that cash value and buy and maybe perhaps a $25,000 or $30,000 death benefit based off of their age. So don't fail to look at those older paid up policies they have out there. You're using paid up policies to buy a paid up single pay life policy. Another opportunity there is a universal life rescue. Universal life rescue is a great option. Back in the mid 80s, when a lot of these clients, these senior clients, were in the prime of their working years, bought universal life. It was a really popular product back in that time frame, where interest rates at that time were 12, 13%, in some cases 14% or higher. And that's what you were illustrating. In a lot of those cases, a lot of that was based. It was sold off of the death benefit, but it was also sold because of the way the cash value could increase drastically on that. I would tell you to look at those UL policies, even though you may not be familiar with them. Always ask them if they have a universal life. They will typically know, because they'll get an annual statement every year that shows them on the back part of that letter. It'll give them a breakdown month by month of what happened in the previous year, on what their starting account value was, what their expenses were each month, their interest credited each month, and then what the next end of that month was for the ending account value. So to give you a month by month over the last year of what their policy is doing. If you see that cash value and that account value going down in that policy, you can say that policy is either not being funded properly. And the client, most cases, the client may know that, but you can look at that and say, okay, if that cash value is dropping $3,000 a year, they got $36,000 in it. It's probably going to run out of cash value. Even if they may be paying premiums on it, they may not be paying enough. So you want to look at that universal life and say, is there an opportunity there to take the cash out of that universal life policy, 1035 exchange it into our single premium whole life, keep that, now have a death benefit out there that will remain the same the rest of that client's life. Although I would tell you that the death benefit is not going to be, because the client is much older, that death benefit is not going to be as high as it was under the UL. But what they're not going to have to worry about is in a few years of that cash value going down below zero, the policy going out of force and lapsing because of that cash value going below zero. What you've done there is, maybe, let's say that client's paying $300 a month toward this UL, the death benefit or the cash value keeps dropping $3,000 a year, even though they're making $300 a month payment. You could take what cash value is left into its single premium, that into our single premium whole life, buy a single premium whole life policy, with a cash value that'll continue to go up from that point, death benefit that'll remain the same for the rest of their life. And then you have access to $300 a month there that you can give that back to that client, that they can spend on whatever they want. Maybe you have another product there that they need that frees up money that you can sell them a different product. A burial account. I always use this as an example. My parents, when we first developed this product, took $10,000 of my mom's CD that she had set aside for her final expenses, so my brother and I would not have to come up with the expenses. She had a $10,000 CD on my dad for the same purpose. I was able to take $6,000 or thereabouts of my mom's CD and buy a $10,000 single premium whole life, tax-free death benefit to my brother and I. I took about $7,000 of my dad's and bought a $10,000 single premium whole life for him as well. So combined, I saved them a total of about $7,000 that freed up for them to use on whatever they wanted, and still accomplish passing on $10,000 tax-free to my brother and I to use towards their final expenses, which is exactly what they wanted. So don't overlook those kind of things. When people out there say they've already pre-planned for their final expenses, get into the aspects of that, how they've done it, where the money's sitting, how they've got the money set aside. Maybe you can help them out more there. I put here the accelerated death benefit feature. Keep in mind that the accelerated death benefit rider is not long-term care insurance. Don't get confused with long-term care. Don't put it down on any type of the forms that you have here that the client likes their long-term care feature. These are not long-term care. It is an acceleration of the death benefit. that we're going to use. So, but what I think here is that sometimes clients have talked about long-term care with either you or another agent. They've worried about it. They've thought about it, and a lot of times when they're thinking about that, one of the hindering factors that keep people from buying long-term care is the cost of it. It's extremely expensive. It is a necessary need out there. A lot of people will need those types of things, but they don't buy it because of the cost. Now here you are talking to them about life insurance and passing on benefits to their heirs, and they get kind of caught there between, well, I know I probably need to buy long-term care. It's just too expensive. I want to pass on as much benefit as I can to my beneficiaries, but I can't do both. And they just kind of sit there on the fence. And a lot of times these clients sit there long enough worried about that they sit on the fence to where either they get too old, they die, or they become uninsurable. The accelerated death benefit rider may help get that client over that fence as a rider on these policies, and that they still have money that they can utilize if they access that acceleration of the death benefit rider to use to help offset some of, if not all of their long-term care expenses that they may have. We'll pay it to them as a lump sum. Again, it's not long-term care. It's not a long-term care type of coverage or rider, but it does accomplish the same types of things. And then some of the other things, you can use it to reduce 1099 income or an exposure to income tax on Social Security. We don't see that a lot. And then if you work in the business market over there, potentially reduce your tax liabilities on corporate retained earnings, or even to finance an employer's obligation under a non-qualified deferred comp plan. Plus, again, we don't see these a lot from a business owner standpoint, but if you work in that business owner environment, you may utilize these as well too, or maybe in that market, a vehicle for after-tax employee contributions. We've gotten all these ideas from people like yourself. So if you have other ideas and things like that, be sure to share them with us. I like to get them out there. I like to get your thoughts on how you're promoting these products and talking to clients about them, how you're uncovering clients' needs. I would be remiss if I hadn't bring up here that we do have an incentive trip. We love to take people on incentive trips. Every agent that qualifies, we take along with a guest. For these two products, it's going to be $95,000 of net conference credit. So it's 10 to 1. So if you write $950,000 of either the Generation Legacy or the Single Premium Whole Life or a combination of both, that nets out to $95,000 of net conference credit. That would qualify for you and a guest to go to Secrets Resort in Papagoya off the Pacific coast of Costa Rica. We would love to host you. The qualification period, we use a calendar year qualification. So the qualification period started January the 1st of this year. It'll go all the way through December 31st of the end of this year as well too. Again, we try not to have any meetings during that time. It's a conference that you qualified for. It's an opportunity to talk about business if you want, but it's really an opportunity to go there and relax. It's an all-inclusive resort. We pick up the airfare for you and your adult guests, and then the resort, all the meals and stuff on the resort, all those expenses are taken care of as well too. So again, we'd love to host you. And I told you that I would pass on the agent services call center number. If you have trouble contracting, you have any type of question that you need answered, feel free to reach out to our agent services call center. You're my client. You're Baltimore Life's client. If you don't like what you hear, or you don't think these products can help you grow your business, then we're probably never going to get that presented to the end user or the client that buys from you. So you are our client. We want to make sure that you're being serviced properly. So our agent services line is designed with people they're designed specifically to help you get the answers that you need to any type of questions that you may have. So that number, you can take that down now, and it's also available on all the material that we have, and again on our Secure Agent website. But it's 877-533-2468. Thank you for your time. I really appreciate the attention that you have here. Hopefully what you found is of interest to you, that it adds some more things to the repertoire of other products that you may have out there. You may be thinking of clients now that qualify for some of these products. You want to talk to about that. I always think that every time you're talking to an annuity client in particular, or clients, Medicare clients that you're talking to about Medicare supplements or Medicare Advantage, be sure to ask some of those questions, identify whether or not they got annuities they're not using to live off of, where they got leave behind money, things of that nature. And I think it's going to open up a world of opportunities for you. With that, thank you for your time. I appreciate it. Have a good day.